Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
This book it couldn't have been timed better. I had no idea that we were going to have the meltdown that we had in July and August, the credit crunch, the disaster in subprime mortgages and so forth. And there are any number of hedge funds that have gone out of business, and a lot of people are getting redemptions, and a lot of people are questioning their ability. And if you're one of those, I feel for you and I understand what it's like. Some people I know said, things were too good, people were making too much money, and there was inevitably going to be some crisis in the financial system, although many people couldn't predict where it was. So it's interesting that I was writing about stress, not anticipating this, but recognizing that in all my books I've talked about stress. Stress is part and parcel of life, and it's very much part and parcel of being a fireman, a policeman, a soldier, and a trader or an investor, because the markets are continually changing. They're highly volatile. They're unpredictable. There's a tremendous amount of uncertainty, and every day is a new day, and it's very much like riding a roller coaster. And so most people who trade learn to experience what stress is about. They learn that the stress response is a normal response to danger. It's the so-called fight or flight response, where the adrenaline starts pumping and prepares you for taking action. The worst case scenario is the deer in the headlights. You don't know what's happening. You're in shock. You're terrified. You're confused. You can't make decisions, or you're making impulsive decisions trying to kind of correct for a drawdown instead of taking a deep breath, practicing relaxation, practicing meditation, getting into a kind of relaxed state so that you can use all your intellectual prowess and your market experience and your intuition to make better decisions. Unfortunately, what happens, it's a self-cycling process. The individual starts losing money. The quant funds, for example, this past summer started selling off. Tremendous amounts of money were going out of the system. Stocks with good fundamentals were losing value, going down. People couldn't explain or understand what was going on. And what happened, they oftentimes held on out of fear, as opposed to saying, well, maybe it's time to start paring back. Maybe it's time to take a second look. Maybe it's time to wait until this crisis passes. Those people who'd been preparing, those people who'd had stress practice or meditative practices, relaxation practices, who were able to use visualization and other such techniques, were better capable of handling this. So there are a whole bunch of things that people can do in the stress situation, but the critical thing is to recognize it, to recognize that the stress is somehow or other distorting their judgment, distorting their ability to make rational decisions, and they've got to be able to take a deep breath, they've got to step back, they've got to reconsider, reassess their strategy, and then begin slowly to get back in as things get better.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Every day I talk to people who are learning how to run a portfolio, and this is something that you've got to consider, that you've got to set a goal. And as easy as that sounds, the vast majority of people are reluctant to do that. And by that I mean, you're running $10 million, how much are you going to make this year? You're running $20 million, how much are you going to make this year? You're running $100 million, how much are you going to make this year? If we say you're running $100 million, you're going to make 10%, so you're going to make $10 million by the end of the year. That's close to $1 million a month. That's a reasonable target. That's $250,000 a week. Okay, what does it take to make $250,000 a week? How many stocks do you need? Let's say you have 10. And so you're going to make, in each stock, you're going to make X amount, X percent of that $250,000 each week. So you want to be thinking about your portfolio in that systematic a way. So how many points or how many dollars up are you going to get in each stock? How many shares do you need? So you build a template and you figure out how big you have to be based on the information you have. Now you got to do the digging. You've got to have a variant perception. You've got to have some knowledge about that company that maybe hasn't reached the marketplace. You've got to do a lot of deep digging. You've got to call around to the distributors and the vendors and the contractors and the customers so that you really understand that company as well as you understand anything in the world. And then you've got to have that variant perception. You've got to figure out when you're going to get paid in that company. So you've got to know what's going on in the marketplace. You've got to know what the sentiment is around that stock. There's a lot of work that you have to do. It's not just listening to television and buying the latest hot tip on Kramer. I mean, interesting stuff, but you really have to, if you're a professional trader, you've got to really do a lot of hard work. So you've got to have a goal. You've got to have a plan in terms of how big you're going to be in your positions. You've got to do the work. You've got to then track it. Biggest mistake most people make is they believe in a stock, they've done the work, the stock's going against them, it's going down, and they keep holding it. And if you review how you've done over the past year, you'll see that most of your losses are stocks that you believed in, that you held when they went against you. The best traders get out. Cut the loss. Wait till it turns around before getting back in. So you got to cut your losses, and then when things are working, you got to think about adding to them. You got to think about getting bigger in your winners in order to reach that target that you've set for yourself for the week, for the month, for the year. So there's a plan, and you've got to develop a plan and then follow it. What keeps people from following the plan is human nature forces them to hold on to losers and encourages them instinctively to get out of winners. To be a successful trader, you've got to master stress and you've got to master the impulse to do the things that are intuitive, because you've got to play counterintuitively. That's the key to success.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
If you're someone who's continually obsessed or preoccupied with your past mistakes, you're having a hard time getting into the now, getting into the present in terms of focusing your attention, it might be a good idea to get out a notebook and start writing those things down until eventually you've kind of expelled it, so to speak, on paper. Maybe it's going to take you an hour or two to write down those thoughts. Now, what happens is the next time you start to obsess, just start writing it down, or remind yourself that you can put these thoughts in the notebook and get back to focusing on the tasks at hand. You may be experiencing as a problem in distractibility. You're distracted from the present, which is really where you ought to be, and are focusing on the past. A very common problem, and something which is usually associated with stress and with getting out of the game. what you need to do is increase the amount of time you can spend focusing on the task at hand, focusing on your goal, focusing on the stocks you've selected in your portfolio, and the work you can do to build your level of conviction. And to the extent you can do that, you'll stop thinking about what went wrong. It's an exercise in time, writing it down and then making the decision to take those thoughts and put them down in your book at a later time after you've focused on the market, may be the critical decision you have to make.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
If you've got a higher percentage of wins than losses, but you're still losing money or you're not making the kind of money that you are making, it really is desirable to get hold of the risk manager and look at your risk statistics. If you don't have them, then it's worth getting in touch with some company that provides that kind of data analysis so you can begin to see where you're making your money, where you're losing your money. Are you holding on to losers too long? Very common pattern. So even though you're winning more than you're losing, you may be holding the losers too long such that the amount that you're losing in your losing positions is greater than the amount that you're making. On the other hand, you may find that you're making most of your money in long-term buckets. You're making most of your money over 60 days. Well, if that's where you're making most of your money, that's really where you want to concentrate your efforts. If you're making most of your money in the short-term buckets, well, maybe that's where you want to concentrate. So you want to understand what your trading pattern is in order to be able to concentrate more on where you are successful than where you're not. You may be losing money in ideas that aren't in the sector that you cover. You may be losing money in ideas that are suggested to you by friends. Been in the business a long time, you have a lot of friends, they call you up and say some stock is particularly good. You don't really know anything about the stock, but you buy it because your friend got you into it. Stock turns around, he may not have the time to call you, so you're stuck with it, you're not following it, you don't understand the nuances, you're probably playing outside your area of expertise. So there are ways of winning, but you've got to study the pattern so you understand your signature.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Guys who won gold medals were guys who had decided to win gold medals. You wouldn't ever, you wouldn't win a gold medal unless you decided to win it. You won't make $100 million unless you decide to make it, or 10 million or 5 million, whatever the number is. So there are a lot of principles of goal setting, of strategy, of staying focused, of building momentum, sustaining momentum, all kinds of things like that, which are relevant, and they probably have a psychological basis, but it's more like coaching and getting people to learn how to manage themselves in high-stress situations. It's like how does Tom Brady throw those 50-yard passes with 2 minutes left in the game? I mean, he obviously just the other day, well, he's not thinking about the stadium, but I mean, that he'd even have the confidence to throw such a long pass. But that's what makes for champions. They've drilled so much, they stay focused. They've got a whole bunch of distinctions about how to do it, and they've practiced it a lot, and so they're able to execute and not be thrown by their own anxiety. They've just learned to ride out the anxiety if they have it. I was at a coaching clinic earlier this year with some of the guys from the San Francisco 49ers and Joe Montana and Jerry Rice and so on. And these guys talked about being afraid of losing. One of the things that motivated them to win was they couldn't tolerate the idea that they would lose. So they used to practice extraordinary amounts of time, and they had it all down, and they were training all year long in the off season as well, so they could, in the last 7 minutes of the game, outdo their opponents. Having the vision in your mind, continuing to do the work until what it is you see in your mind, you realize in reality. It's like a sculptor.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
The most experienced guys and the guys who are very successful have learned from experience to embrace the anxiety, to recognize that as bad as it is and as much as it seems like they're going down, that the storm will pass. It's kind of like when you become a more expert skier, you learn how to slip down the mountain. You learn that skiing is really sliding down. You learn how to manage when you're out of control, how to control the out of controlness, or when you're in a sailboat and you're heeling and it feels to the new sailor the boat's going to flip over until he develops confidence that the keel will keep the boat balanced even though it feels like it's going to flip. And experience teaches you to be comfortable with that inner uncertainty. I don't know if you remember taking a multiple choice tests in the GMAT or the MCATs or whatever it is, where you have 5 answers in a multiple choice. 3 of them were absolutely wrong, and there were 2 that looked right, and 1 that looked like it was definitely right, and oftentimes that was the sucker answer. In the heat of the anxiety of the stress of the test, the tendency is to go for that answer because you're in a rush to get past it. The person that gets skilled gets comfortable picking the answer that isn't quite right until he begins to feel comfortable with that kind of putting English on it, so to speak. You've got to learn to stand outside your own reaction and not to let your reaction govern your responses, but let your strategy govern your responses. So the first book I wrote was called Trading to Win, which I recommended that people have a target, a goal, and then reverse engineer from the goal to specific stocks in terms of deciding how big they had to be, how many shares they needed, how much work they had to do, and so on, so that you could begin to function in terms of a blueprint rather than in terms of serendipity or just hoping against hope that things would work out. So you can kind of impose a plan on the unstructured, uncertain market environment. Today I've talked to 2 or 3 people. I mean, one guy who said, this is really awful. I was up $22 million 2 weeks ago. I gave back $12 million last week. This is awful. I don't know why I'm in this. He feels kind of like somehow or other he picked the wrong stocks. He wasn't as bearish as other people were, and so on. And where he's usually accustomed to doing very well, he's feeling a bit overwhelmed. It's kind of like, do I still have another article or another book in me? The markets keep testing people, no matter how skilled they are, and lead them to question themselves. Another example of a guy who's saying, we've had a drawdown, I'm not going to pay my analysts as much this year as they're expecting, and now all these guys, they don't appreciate that I, as the portfolio manager, take the risk, take the responsibility, have to really actually man the steering wheel, they still have their expectations. And I'm really burdened by the personnel demands of the people that are working for me. This is what this kind of a market does to you. I see guys exercising, guys trying to stay in shape, guys trying to cut down on the amount of times they go out in the evening with companies or analysts, or they're trying to stay in shape. I'm not necessarily advocating that. I'm just simply saying guys have bad days. They go home and have tough nights. The best guys over time, year after year, are right 60% of the time. They're wrong 40% of the time. There are guys who make a lot of money who are right 50% of the time. Within that, they make more money in their winning trades than they lose in their losing trades. So the slugging ratio, their win-loss ratio, is better than 1. If you look closely at where they've made their money, you generally find, and I've done this over and over again with a lot of people, that most of the money is made in 3 to 5% of their trades. So even though they're right, they're really making their profits in the outsized bets that they're making, which generally they make when they start seeing things work. So they've really learned how to press their winners. That means that these guys are very not comfortable. They're very accustomed to failing, have learned to adapt to failure, recognizing that it goes with the territory. You know, this is the life we've chosen, so to speak, and we're going to have a lot of bad days. We're going to have a lot of bad nights. If we keep hanging in there and keep doing our work and stay with our strategy, really not get psyched out by what's going on in the market or the world, we're basically going to be able to survive. Confidence, that's experience, and it's the difference between the winners and the guys who are just average performers.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com.
Here's a simple visualization exercise. You can use this in almost any situation where you feel the need to center and calm yourself. It's a metaphor for a safe zone. Once you get the gist of the exercise, it is almost like carrying around a gold nugget. Whenever you are feeling nervous about a new situation or upset by an intrusive memory, you can reach into your pocket, metaphorically hold the nugget, close your eyes or stare at the wall, and bring your mind back to a state of relaxation. Breathe slowly, evenly, neither forcing nor holding back the natural flow of air. Your body knows how to breathe in a regular, easy fashion, and the only trick to relaxed breathing is to listen to your body's own messages. Once you've relaxed and regulated your breathing, focus on some pleasant place you've visited or imagined. It could be a lovely beach, a peaceful meadow, or a quiet room in a house. Imagine you're there in this special place, taking all its sights, smells, sounds, and feelings. Stay here in this place for as long as you can.
Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
I think that the most common trend among successful professional portfolio managers is probably, there's no one trend. Some people, this again is the value of doing, looking at the performance statistics of a trader to be able to see to what extent he's holding his positions too long for an extended period of time, and thereby even after the stock has reached his profit, his price target, he continues to stay because he's feeling somewhat elated and euphoric and thinks he can make more money, but hasn't necessarily done more work. This will show up in his statistics in the sense that he'll begin to show losses for long-term held positions. He may need to be guided to when you reach your price target, unless you've done more work and have some new catalysts and a new thesis, it's probably time to start paring back. On the other hand, some people may find that they make most of their money in the short-term time buckets, don't hold long enough, and they need to be guided to consider that they may be impulsively getting out to get their profit. When they do that, they're leaving money on the table. There are different patterns, and these different patterns show up in the same trader over time. You want to keep looking at the stats and the game films to see how people can adjust their portfolios so as to maximize their profitability. The book that's coming out now has to do with mastering trading stress. And I have a book coming out in February called Hedge Fund Leadership about how to empower people and so forth. And I was thinking about what the underlying thematic principle is in a lot of my coaching, and that while I'm saying things that are common sense, what I'm generally advising people to do is to function counterintuitively. If you're feeling anxious, don't try to deny it, don't try to stuff it, don't try to mask it. Embrace it. Understand what you're feeling. Share what you're feeling. Be willing to be vulnerable. Be willing to discuss that anxiety, because to the extent that you do, you recognize your humanity. You empower other people to recognize their humanity, to be more open and frank. Ultimately, trading is very much a signature activity. It's a creative activity which expresses, as I said earlier, not only intellect, but heart and passion, as well as guts. And the more you understand how you're responding to the uncertainty and the unpredictability of the market, and can allow yourself to feel what you're feeling and then trade independently of those feelings, the more successful you're going to be. If you're working with people to empower them, you really want to find out where they're coming from so that you can encourage them to be more of who they are, to function more in terms of their strengths rather than in terms of some top-down command, control, military, hierarchical approach to leadership. Much of what I'm saying is to embrace the emotional side, not necessarily to trade in terms of emotions, but to recognize them so you can trade independently of the emotions. You can trade in terms of the blueprint or the plan or the requisite work that you need in order to perform as big as you can. And ultimately, the biggest thing in trading success is the belief in the vision that you have for how much money you're going to make and what you have to do to create the portfolio so that in a given particular market period, you can maximize your profitability.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
You want to be trading because you understand the probabilistic pattern to the stock. To the extent you're trying to cover up the fear and look like you're in control, you're using up a lot of your energy. Much better to just notice that you're anxious, to start keeping a diary of what you're feeling so that you can begin to understand these feelings, understand that they're time limited, and understand that they don't necessarily mean anything, and you don't necessarily have to act or take action impulsively in order to minimize the expression of those feelings. So what I'm saying, it's better to just simply say, hey, I'm really scared, I really had a bad night, to understand that this is just part of the human response to stressful experiences. Yeah, since the summer, there's been a tremendous increase in anxiety and lot of anxiety, a lot of depression, a lot of second guessing, a lot of loss of funds, closing down of funds, a lot of difficulty. A lot of people. I talked to somebody this morning who said he was taking 3 months off and he didn't want to think about the market because it's been so tough. People are worn out, very much so. I think this fellow had kind of reached a point where he was a little less than flat, was feeling very disillusioned, didn't feel his process was working, wanted to take some time off to rethink. Maybe that makes sense. I mean, I could see some instances where one might make that recommendation, but to the extent that he was feeling that way, well, I can understand it. The other thing I ought to mention is I just set up a website, www.arikiev.com, and there's some videotapes on it and some podcasts and some other things relating to this new book. So some of your readers might like that.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Yeah, I think the critical issue for professional traders and in volatile markets such as we're seeing now, and certainly for non-professional traders, is to learn to recognize when they're under stress, when their stress reaction in terms of anxiety, palpitations, self-doubt, self-deprecation, hesitancy, inability to make decisions, when all these things are reflective of the stress they're experiencing, that the experienced trader, to some extent, has learned over time to recognize his own symptoms as indicative of the underlying state, and to recognize that this is a time to pare down, to step back, to try to become a little bit more objective, to become more centered psychologically and more in a kind of tranquil or meditative state so that he can see the market reality for what it is and not overreact in terms of his own panic reaction and in terms of his own reaction to his own reaction, all of which can produce either paralysis, where he's reluctant to get out of losing positions and takes bigger and bigger drawdowns, or he takes his profits too soon in trades that are working, or he chases after opportunities that aren't as well vetted or analyzed as he might under ordinary circumstances. The lesson is self-awareness, review of the game films, review of yourself, keeping a diary, keeping track of your own emotional responses, which are likely to be repetitive over time. So even if you become experienced, how you deal with stress is likely to be, or your stress response is likely to be very similar to the way it was in the past, but you may have learned some techniques for reducing the stress. The best traders have a set of rules to follow, a game plan, a blueprint, a scenario analysis. They've reviewed in their mind and perhaps on paper how they're going to deal with a variety of events. If the Fed raises, if the Fed lowers, if the earnings numbers come in better than expected, if they come in lower, they have a plan of action in terms of how they're going to deal with events. They have a plan of action in terms of how they're going to deal with drawdowns. They aren't necessarily rigid about it. It's not such a cookie-cutter thing. They have some flexibility and some preparedness and some willingness and flexibility to adapt. but they follow these kinds of guidelines. The point to emphasize there is that, and this is something that the amateur can learn, that the professional is really not necessarily smarter, but he's spending more time in analyzing the companies that he's investing in. He's spending more time looking for the negatives. If he's optimistic about the stock, he wants to talk to some people that have a bearish view. He wants to have them challenge his argument. He's really willing to face the truth more so than the average person, because he knows that ultimately the results will be based on having done as thorough an assessment as possible. This is hard work, but it's the work and the preparation and practicing the fire drills for dealing with emergency situations which differentiate the skilled professional from the amateur. You've got to know that if you're running so much capital, if you start to draw down and you don't pare down your positions and reduce your risk, that you run the risk of losing all your money and being out of business. And so you have got to really practice in your mind, on paper, and then eventually over time during quiescent periods, so you're better prepared for the difficult periods. You've got to practice paring down your portfolio. You've got to practice getting bigger. You've got to practice being nimble. You've got to learn a whole range of ways of behaving so as not to get yourself caught in a trap.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
It's improved a little bit in the last couple of days because of the Fed lowering the interest rates. I mean, the symptoms of stress that are experienced by traders, it's a whole range of things, from people who can't eat, people can't sleep, people can't concentrate, people are paralyzed. I talked to one guy yesterday who believes in his analysis. He believes that the stocks that he's in are good, so he's holding on as the prices keep going down, and he's losing more and more money. So his risk management has gone to hell because he's somewhat paralyzed by fear and by his conviction in his belief. So all the work he's done, which has helped him in the past and which he keeps recollecting, somehow or other takes him out of the game at the present time. When investors are calling because the investors are starting to panic, the fund managers have additional pressure on them. People who have what they call sticky money, that is locked up money for 2-3 years, are able to ride this downward volatility much better than those who have shorter term money where people can redeem in a month. And the panic starts affecting the investor base as well as the hedge fund and managers and the traders at prop desks. I help people by helping them to understand how much of their reaction is a normal reaction, that they've got to detach themselves a bit from their own emotionality. They have to rely on good risk management principles, pare down their portfolios, reduce the low conviction ideas, perhaps even reduce some of the high conviction ideas, so they can keep their powder dry, or keep enough powder dry so that when the markets start to improve, they can get back in and take advantage of the lower prices. It's important for them to develop a strategy, to review what's been working, what's not been working, and to be willing to dig in deep to make the personal changes that are necessary to reduce the stress that's created by the way they're managing their portfolios. If people are interested in my book called Mastering Trading Stress, or they can go to my website, arikiev.com, which makes reference to some of these things. I teach people to practice centering exercises, relaxation, visualization, meditation, getting into a much calmer, centered state so they're not as overreactive to the market events and are better able to do what's rational in the sense of preservation of capital and managing their portfolio in a more sensible way. The principle in any meditative exercise is to learn how to get calm, and to the extent that somebody practices that daily. I have one man I talk to who spends 45 minutes a day, starting the day doing yoga and visualizing his trades and so forth in that very relaxed, centered state, so that when he comes in and he begins to experience stress during the course of the day, he's able to get back into that centered state because he's learned a set of reflexes that enable him to get into a meditative centered state where he can see things more calmly and act more rationally. Visualizing yourself as a tree stump sitting by a stream in the mountain can be very relaxing. You can imagine yourself sitting at the beach. You can imagine seagulls flying over and coming down with the balloons that they hold in their beaks and allowing you to put your negative and fearful thoughts in the balloons and then watch them float away. So you can develop some mental skills which enable you to reduce the sense of panic and despair and anxiety that's frequently associated with market downturns. My work with athletes is very similar in some ways to the work with traders, in the sense that the best athletes were usually people who set goals, who set targets, who then reverse engineered their exercises and their training regimens in order to build themselves up in terms of strength, aerobic capacity, mental toughness, competitiveness, in order to be able to perform in high stress situations. And I think traders are very much functioning in the same kind of intense, high performance type of environment where it's critical to have a plan and to work the plan and to keep performing in terms of outperformance targets and doing the necessary requisite work, building teams and so forth that enable you to get an edge so that you can produce good results. And in difficult times, you can reduce your losses. A percentage of people, certainly if they're under severe stress for a period of time, if they become overwhelmed by their experiences in the market and they're predisposed to get depressed, may very well suffer from clinical depression. But by and large, though, the majority of seasoned, experienced traders have been through these times before, particularly the older ones, and they've learned techniques for riding out the difficult times. And I think this is something new traders have to learn. I've been doing this for 15 years, and in that course of time, I may have found a few people who were clearly in the wrong job. The vast majority of people, by the time I see them, have really been through a lot of training and a lot of screening and a lot of experiences, and they may have to make some adjustments. They may have to go back to being analysts. They may have to go back to running smaller books. It's fairly infrequent that somebody who's been doing this for a living for some time has to change his career.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
The thing that causes so much stress is the fact that it's hard to predict what's going to happen. So traders are continually dealing with uncertainty and unexpected events. And in this kind of turbulent market, all kinds of variables begin to have an influence on the way stocks trade. And the usual fundamental analysis, which gives them an edge in understanding product cycles and supply-demand characteristics and competitive advantage, seem to go out the window. It's a roller coaster. In this kind of volatile market, it's like a roller coaster that's out of control, and you're looking for all kinds of ways of putting the brakes on, and the brakes aren't working as well as they ordinarily might. So it's a difficult time, and a lot of people need to be able to stand back, get some objectivity, pare down their weak positions, their hopeful positions, their low conviction ideas, and also pare down even their high conviction ideas in anticipation of the fact that the market at some point will bottom and they'll be able to buy things at a cheaper price, and so they don't have to lose as much money with the hope that eventually it goes back up. The biggest thing that gets in the way is their belief in a particular stock or investment. They've done the work. They think the market's wrong. They think that the value will eventually be realized, which may very well be true. But the savvy investor recognizes he's got to kind of preserve his capital. And so he's looking for ways of playing in a much more risk-averse way. I would distinguish between good stress and bad stress in the sense that the person who's focused, who's got the adrenaline going, has an increased sense of alertness, who's able to focus in on targets and on the necessary work, may be more motivated than somebody that's not as keyed up and prepared for the event. It's where the reaction begins to take on elements of superstition, of overreactivity, of reacting to your emotions as opposed to using your emotions as a kind of indicator of how things are going, that the individual begins to get overwhelmed by his own reaction, his own over-interpretation of events, his calamitous thinking, his catastrophic thinking, and that's where he either may be paralyzed and unable to move, or he may be impulsive and trying to hit home runs in a market which is lending itself at best to hitting singles. We're talking about billions and billions of dollars. I think the couple of things to do to deal with fear is to really review the game films, see what you did right and what you did wrong over a period of time, begin to understand your patterns of trading, begin to understand ways of maximizing your strengths, maximizing the kinds of research work that you've done, maximizing your ability to put together a team of analysts and so forth, and then developing a plan, reviewing what one would call a scenario analysis of the different ways in which you're going to act depending on how events go. There was an ISM number that came out today that was a lot lower than what people expected. If you had prepared for that by saying, if the number is low, then I'm going to go long treasuries, or I'm going to short dollar yen, or I'm going to short the S&Ps. If the numbers are pretty normal and don't show any decline in manufacturing or other kinds of economic indicators, I'm going to stay stable. So you plan in advance of the events what way you're going to act. That gives you a little more control of your own emotional responsiveness to or reactivity to the events. Another thing to do is to begin to practice on a very systematic basis some kind of meditation or relaxation exercise on a daily basis, so that you're able to get centered, you're able to get not reactive, not emotional, and to be able to look at data and process in a more objective way, so that when you're in the midst of the stress, you've been there before, you can tune yourself down, calm down, get centered, and keep redesigning your strategy and focus in order to accommodate to changes. Preparation, review, maximization of strengths, and so on will all help you to handle these crisis events.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Communication is critical for good leadership, and a good leader has to make communication a priority and work to establish opportunities for the team to develop communication skills. Whether in a weekly consultation or intensive several-hour consultative seminar, I encourage you as the leader to set aside a specific time to examine a variety of issues with your trading team. As you and your team openly discuss these issues, you'll rapidly get at the heart of some of the issues that keep people from being as effective as they can be as traders and leaders. Here are some of the issues that you need to address. The most common psychological problems: lack of specific goals, an inability to cut losses, panic, fear of success, fear of losing, euphoria, gambling impulses, and perfectionism are some of the most common problems that you'll face. 2, problematic trading patterns need to be looked at, such as not trading big enough, not holding long enough, holding too long, excessive caution, inflexibility, paralysis by analysis, excessive risk-taking. It's also useful to look at trading strategy in terms of sizing, conviction level, price targets, and P&L goals. You want to have your team discuss investment ideas vis-a-vis specific companies in terms of bullish and bearish case, catalysts, risk-reward parameters, and variant perception. That is, what was known at the time of the investment that no one else knew, which gives your traders and portfolio managers a trading edge. Next, you want to look at examples of best and worst trades, and you want people to discuss this in an open forum so that they get past any concern about their image, how they look, trying to appear better than they are, and you want them to be able to embrace mistakes, to learn from their errors, and the like, so that there's no psychological overlay around their communication. You really want people to provide summary sheets of trading stats, if available, in terms of P&L, the amount of capital being used, the percentage of winning days, the ratio of the average amounts of money made on winning days divided by the average amount of money lost on losing days, the so-called slugging ratio, and any other statistics which might be illustrative of trading patterns. You want to hear about thoughts about trading objectives and examples of experiences in dealing with analysts, risk management, and management, including communication issues, command and control issues in the organization, and the like, in order to empower the team by initiating openness and the sharing of vulnerability. Receptivity to coaching is another important consideration which comes out in these meetings. How much can the team admit to vulnerability and their need for support? You also want to examine spreadsheets illustrating the sizing of positions, hedging strategies, and the level of conviction of ideas. In essence, the more you bring to the table, and this holds for everyone on your team, the bigger the impact the meeting will have on you and your team, and the more you'll accomplish during the session. If you really put yourself out there by exposing some of your own performance, as well as the performance of the people on your team, and if you're willing to explore the good and the bad, what works and what doesn't work for yourself as well as your team members, then you'll walk away with a huge win in terms of understanding the behavioral and attitudinal changes in yourself and others. This open dialogue will translate into profit potential in your own trading and that of your team. Perhaps most importantly, such a dialogue invites the opportunity to break through and develop team connections. There is suddenly an opportunity for everyone to see that leadership is not about demanding something from people, but about providing a setting in which everyone can voice concerns, fears, self-doubts, differences, and even disagreements without fear of retribution. These kinds of group discussions encourage people to see the nature of sharing, help overcome the natural reluctance of others to speak out, and challenge the status quo. As team members learn to share their dreams and identify everyday obstacles in the life of the organization, what often emerges is an amazing interaction that was not previously present due to the fear of lack of time or opportunity. Such discussions will help foster a sense of teamwork, loyalty, and motivation, as well as motivate better performance and a more competitive edge. And you want to move forward on the continuum of leadership and empowerment. This is Ari KIEV, www.rekiev.com. Thanks for listening.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his twice-monthly podcast full of real-world advice on how to maximize your trading potential at www.rekiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Coachability has to do with, in the most simplistic sense, ego. You want people who are confident, who are self-assured, who believe that they're going to succeed, but not so confident that they're arrogant and believe that they walk on water, that they can function without assistance, that they can function without someone helping them to see how they could improve. And so a critical thing in evaluating an individual as to whether they have what it takes to be a successful trader, and a lot of this is discussed in my book, Hedge Fund Leadership. The best leaders are people who are able to empower other people, but to empower them, people have to be empowerable. They've got to be open. They've got to be receptive, and the leader's got to be open too. The more he can identify his vulnerability, the more he can admit to the fact he's having trouble sleeping, that he's worried, that he has no lock on the future, the more he can encourage others to open themselves up, to dig in deeper, to recognize that you can't rely on yesterday's performance. You've got to reassess the market. You've got to decide what new data is important. You've got to go out and dig in, visit companies, talk to managements. You've got to really do a lot of work in order to perform and succeed. This is very tough work. And the best people are probably in they may live in mansions, but basically they're humble. They don't think they have the answer. They're very receptive to the inputs from a lot of people, because you never know where the input's going to come from. As much as the world's the same, it's always changing. And so the more times you've dealt with a storm when you're sailing, the better you get, but no two storms are the same. In the markets, no 2 years are the same. You know there are going to be those so-called black swan events, those catastrophic events. You know they're going to happen. You know there's going to be tough times. But to the extent that you're experienced, you know that you can weather the storm. So when the storm starts, you begin to pay attention to the signs. Then you begin to pare down. You get out of low conviction ideas. You go to cash. You even pare down your high conviction ideas, waiting for the time when things bottom and turn around, so you can increase your profitability and reduce the potential of losing, which invariably is an ego thing. People love a company and they feel they've done the best analysis, and they don't want to admit that they may have been right, but the market's telling them something else, and the market's bigger than they are. And that's a very tough lesson to learn. And to some extent, you can sometimes recognize that quality in people before you even hire them. And to that extent, you can say, you'd make a great analyst, but you probably wouldn't make a good portfolio manager, because the portfolio manager's got to be flexible, nimble, adaptable, and humble. It's interesting. I just spoke to somebody early this morning who was about to enter into a poker tournament, and he said, "Do I have any advice?" I said, the first piece of advice would be, don't hesitate to get out of a losing hand. The second piece is, don't hesitate to get out of a winning hand. You got to know when to fold. You got to recognize that the best players recognize that not every hand is a hand to be played. And to the extent you're using probabilistic theory, it's kind of like handicapping at the racetrack. You're trying to figure out whether what you know is built into the stock or not yet built into it, but that it eventually is going to kind of manifest itself when various events occur. So you've got a path to getting paid. You know the horse is going to win, even though it's not the best horse, because when you look at the track and you look at the competition and various other things, the odds become very favorable, or at least the odds make it a winning bet, even though it's not the best horse. You're continually using probabilistic models to make the best bet, and you're doing the same thing in trading. You recognize it's about winning, but that winning isn't about feeling good. It's about doing the best you can under the circumstances and knowing when to pull the cord to get out, so that you've got enough money left or enough resources left to go on to play the next day. The best players begin to have or have early on learned that it's important to manage their emotions and not to allow the fear or the greed to dominate their play. And so they begin to separate what they're feeling from how they're executing in their portfolio. And you're never as good as your successes suggest you are. You're never as bad as you think you are when you've done poorly. Self-awareness, self-examination, looking at the game films, getting some kind of guidance as to how you're handling things becomes a critical component of this. Trading and portfolio management is very much a signature activity, like painting is. There are no two guys who do it the same way. The best way people can learn, at least I teach this, is that keep very good track of your own performance so that you can see how you did, how you felt when things went one way or another, and then you can use that data to understand how you might play it the next time around and where you have to adjust. The information you have about yourself and your characteristic ways of responding are unique to you. The more you understand that, the more you can stay focused and concentrated on the facts and not get carried away by your interpretation and your emotional reactivity to what the events are. this is what maturity is, this is what mastery is, and it doesn't happen overnight. It doesn't just happen because you decide it's going to happen. You've got to work on that by very careful review and observation of how you're performing, or even learning how to observe yourself, because you are the ultimate instrument of your success. Well, target setting is important because you want to have a framework for deciding what work you have to do, how much more work you have to do. If you've reached your target and you've reached it too easily, maybe you need to set a more challenging target. You don't want to just be bored doing what you're doing. If you haven't reached it, maybe you set a target that was beyond what's possible at the moment. Self-awareness is really what you need, and the ability to kind of reflect on how much you're letting your ego get in the way. If somebody is burned out, it's probably not the best time to make the critical decision. It may be time to take a break and take time off, take a retreat, do some self-assessment, and maybe, reconsider. They may just need a little time off. They may need to redesign their strategy. They may need to examine whether they had a strategy. They may need to articulate a better strategy. They may be able to do some of the things they were already doing, but in a different way. Sometimes a PM is better off being an analyst. Sometimes an analyst is better off being a salesman. He really has more personal skills than he does have analytic skills. He may want to be an analyst, he may want to be a PM, but he really would be good on the sell side. I think it's valuable to assess what your real strengths are, not necessarily what you want to do, and then find a career within the financial community that relates to what you've already done. I wouldn't minimize the value of your past experiences. Just a question of getting a better handle on what really works for you and what really doesn't.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
The principles that I've developed, and you can read this in The Psychology of Risk or in Hedge Fund Masters, the people with longer-term horizons have the same mandate to have a goal and to have a plan and to have some kind of risk management principles in place, so that they've got to pay attention to what their drawdown limits are. You don't want people to build up too much of a drawdown, even though they believe that in 3 years the stock is really going to be a double or a triple. You want to manage the drawdown, keep the volatility down, which means when things aren't working, even if you expect it to work long term, you want to pare down those positions so that you're not building up too big a drawdown and hitting your so-called down and out, the number where your portfolio gets shut down. So just because you know long term it's going to work, it doesn't mean you ride it out. Now, if you've got a cushion, if you've done a lot of work and you're really sure that the decline in a stock price is for fallacious reasons or negative rumors or some misinformation, well, you can take advantage of that and get bigger. But I wouldn't necessarily say that people ought to do that arbitrarily. They really ought to make sure they understand the company, they make sure they understand nothing's changed, and there really isn't a significant differentiation in the market. As a principle, keeping within limits has value. Taking the pain on the grounds that, well, you've got to take the pain before you can succeed is more often than not a rationalization. So I strongly advocate following risk management principles and keeping the drawdowns to a limit. So if the down and out is 10 million, or say 15 million, when somebody is down 3 or 4 or 5 million, it's time to really start thinking about paring down the portfolio, getting out of stuff that's not working. It's much more difficult to make it back than it's easy to lose it. But having goals and having a strategy and knowing how many ideas you need and doing the work and building a team of analysts to generate enough ideas so that if you're looking for a 40% return per year on a stock and you find 4 stocks that'll move 10% a quarter, you may be able to take the profit after 10% and then put your money into another stock that's beginning to move. You don't have to stay with one position. If you've got a 3-year horizon, you can hold it longer as long as it's not hurting you. I think that's an excellent question. How do you try to find order with fundamentals and technical analysis to bring order to the markets and then let go of control? It's very much like a musician who's preparing for a concert, and when he's practicing, he's going over every note and every passage and making sure his timing is right, and he's really perfecting it and getting it down using the musical score. When he's in the concert arena, he's performing and he's letting go. He's not trying to do it in as controlled a way as he's trying to do it when he's practicing. So letting go of control is trusting his instinct, trusting his preparation, trusting the fact that he's visualized doing it correctly any number of times, and he's now going on instinct, built around a lot of thorough work and thought and so forth. So the master trader has done the work, has gathered the information, has analyzed it, has reviewed it with his analysts, has a plan, and now when he's in the market, he's relying on his experience, on his pattern recognition ability, on his intuition, on his feel for the flows and the movement and what's happening in the stock. He may be trading around the position. He may be getting bigger. He's relying on a lot of live information coming in, which is integrated with what he already knows. So it's a combination of preparation and thoughtfulness, and then trusting to instinct and just going with the flow. If you're overthinking it while you're in the middle of it, just as when you're skiing and overthinking, you're more likely to fall. Same thing with sailing. You got to learn it and practice it, and then you have to kind of go with it. How do you deal with letting go of control and combining that with fundamentals? I think the answer is, and again, I refer people to my website where I have a number of podcasts talking about relaxation and centering, and I think people ought to practice yoga 20, 30 minutes a day or meditation when they're not in the heat of the battle, but before they come in or at the end of the day, so they can learn to tune down and reduce their emotional reactivity or anxiety levels so that when they're trading, they can be more focused on the task at hand and not coloring things by virtue of their own emotional responses. So the more people learn how to cool down and stay centered and stay focused and not allow their own emotional responses to interfere with their performance, the better they're going to do. So you can practice any number of things. I think those relaxation exercises are useful. I think beyond that, it's a very useful thing to visualize what you're going to do, to practice in your mind, to be able to see, to have a plan what you're going to do if the ECB raises rates, what the consequences are going to be if that happens, and how are you going to play that? What are you going to do if they don't raise rates? What are you going to do if they raise rates but are dovish in their forward-looking statements? What if the Fed doesn't respond? So you can have some preparation and some alternative ways of responding and be prepared for dealing with events when those events come about. It's a combination of centering, meditation, relaxation, and then planning for alternative events and having a plan of action You don't have to first start making the decision when you're in the midst of the situation.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Yeah, I think risk and reward are really essential to success in sports, in skiing, in concert performance, in any number of activities, and that it really entails a tremendous amount of preparation and practice and review and really going over the details, and then in the performance situation itself, really letting go of control and allowing for some spontaneity and creativity to play out. The better the performer, the more willing he is to let go of control, to trust his instinct, to trust his intuition, to trust the pattern recognition patterns that he's learned over time through experience. And that's the sort of the art or the psychology of trading. The better guys are able to go with the flow, or able to relax, to, like when you're skiing, if you pull back because you're afraid of falling, you're going to fall into the mountain. You got to kind of go forward and let gravity pull you down. When you're sailing, you've got to get to the edge where you're getting the best opportunity to pick up the wind and so forth, but it's a little scary. So much of my work with traders and portfolio managers is helping them to learn to get comfortable with discomfort. It also applies to taking more risk, getting more comfortable, putting on more capital in high conviction ideas. So you encourage people to do more work, to really understand their companies, understand the transformative events, understand the variant perception, have a path to getting paid. It's not just putting the position on, it's really understanding what you need to know so that you have the confidence to take that risk. And the more risk you're willing to take, the more opportunity you have. You know, it's getting to that sweet spot, which is usually beyond the level of comfort. It's not such an extraordinary risk that you're totally out of control and you're putting yourself at great peril. But it's a balanced risk taking where you're taking enough risk to be able to kind of get into the perfect line and so forth. I'm not familiar with any particular studies, but I would say that, you know, when you look at a large group of portfolio managers and you review their performance, you find a wide range of practices, from people who are reluctant to take risk, reluctant to use their capital, to those who are whose use of capital is pegged to their buying power. So somebody has $200 million of buying power, they're using most of it. Somebody who's more cautious and conservative, year in, year out, will use 50 or 60% of his capital, arguing that the market isn't right, I don't have any good ideas in my sector, I'm waiting for the price of oil to go down, waiting for the economy to stabilize, and they're very good at finding rationalizations for not committing and deploying more of their capital. Clearly, in working with hundreds of traders over the years, I'd say there's a bell-shaped curve of guys who are cautious, conservative, maybe even fearful, to those who are real confident, comfortable risk takers who use their capital and do the work required and have a strategy. There are two critical variables that I think one finds in the most successful traders. First is their ability to cut their losses. If something's not working, they get out. There are some value investors that say, well, if I liked it at 20, I like it even more at 10. So they buy it as it goes down or double down. But some of the best traders get out, wait till the thing reverses before they start buying it again. So they're managing their losses. That's the first thing. And that's a counterintuitive thing. It's natural for people to hold on to their losers, to take more risk in situations that aren't working than in situations that are. You've got to learn to be able to let go and admit you were wrong. Not easy for people to do. The second lesson that people have to learn is to recognize that most of their profitability occurs in about 3% of their trades. So even though they're right, say 60% of the time, most of their money is made when they identify something that's really working and they press the pedal to the metal, so to speak. They get bigger, they add, they take advantage of momentum, and they recognize that this may be one of those few trades that's going to really make me a lot of profitability this year. So they're able to identify that and go for it. That, again, is something that has to be learned because it's a counterintuitive thing. The tendency is for people to take their profits too soon and miss a lot of upside opportunity. So that's the second thing the best traders learn to do, and that's really pushing themselves to get bigger even after they've reached their price target. People who are portfolio managers in hedge funds are certainly more likely to be risk-seeking individuals than, say, your ordinary citizen who doesn't play in this arena. That being said, there are many people who are, who are really good at taking risk, and as I've indicated, there are many that are a little reluctant to take risks. So there's a range of personal styles. Some are more risk-averse than others. Even though the guy is taking risk, he's taking small risk. He's using less of his capital. He's not willing to take a 10% position when he has high conviction. He's a bit of a perfectionist. He wants to get 90% of the information when maybe all he needs is 60% of the information to put on a big position. Another venue is, and I've said this often, that taking risk is like a multiple choice test where you've got 5 answers, 3 of which are absolutely wrong, and then there are 2, one which looks like it's the answer because it has the answer in it, and one which doesn't have the answer in it. And in the heat of or the stress of a test, people go for what I call the sucker answer, the one that looks like the answer but isn't. To go for the right answer, you've got to kind of take a risk that something that doesn't immediately appear to be the answer will be the answer. And the more you answer those questions, the more comfortable you get doing something that's a little bit uncomfortable. But then you somehow or other know you're right. And that stretch to do something that's a little uncomfortable is really what it's all about.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
I mean, it's probably all on a continuum. I think people who are in crisis because they're suffering from a depression or a major loss in their life or some, intra-family conflict, perhaps at one end of the spectrum. I think Olympic athletes are probably at the healthier end of the spectrum in the sense that they're generally fairly adaptable and pretty resilient and probably not suffering from psychiatric conditions. So the focus is more on maximizing performance as opposed to reducing stress. That being said, athletes, traders, and functioning people in high-stress situations experience a certain amount of stress and can benefit from learning stress reduction techniques. In fact, today in the Wall Street Journal, there was an article about the increased practice of yoga in the financial industry because people recognize the value of meditation, the value of centering and calming yourself down in the midst of chaotic day. I think some of the same principles apply. Managing stress and learning how to become detached from the emotionality of the athletic performance or the trade can certainly help an individual in terms of the way in which they function. I would recommend to people who are well that in order to be able to deal with uncertainty and to be able to deal with the anxiety associated with taking a bet that doesn't look like it's going to work for a while, to be able to be in a short position that's going up in your face and take a lot of pain requires a certain amount of resilience, a certain ability to be emotionally detached from the trade itself so that your own emotional responsivity doesn't interfere with your objectivity and your judgment. And some of the same principles that would apply in the clinical setting apply in the work setting. To what extent are there certain commonalities to those people who are successful? I think it's fair to say that irrespective of the strategy that people rely upon, there's a multitude of personalities and personality types, but the underlying common ingredient would be a purposefulness, a goal-directedness, a commitment or a willingness to commit, a willingness to do the kind of work that's required to give you an edge, a willingness to dig deep, to develop comfort in having what's called a variant perception, a view of things that is not yet consensus, that's not yet known in the marketplace, but that will eventually become the consensus idea. To be able to do that requires a little bit of body English, it requires confidence in your process, and a willingness to be wrong for a while. And that takes a certain amount of ego strength and resilience and the ability to come back from failure. Those are probably traits that one would find in the best performers. I think associated with that is a willingness to look at the game films, a willingness to review what you've done, what worked, what didn't work, a kind of ruthless honesty about what you're doing, and a willingness to take constructive criticism, which I must say not everyone is willing to do. Some of the things that interfere with that process, which make it hard to coach people, is a kind of perfectionism, a need to have all the information, a need to be right, even if the market is telling you you're wrong, a kind of stubbornness, an inflexibility, and some of those things are hardwired, and it takes a lot more time and effort to get somebody to work around some of those kinds of traits. The best candidates for the kind of work that I do are flexible, are inquiring, are curious, are students, are learners, are people who are willing to experiment and to review what they've done in order to get better. So the best guys are guys who are continually upgrading their game.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Certainly, you've got charts, you've got the chart pattern of a stock. You can really review where you got in, where you got out. You can keep track of your entry and exit points. You can track what you were feeling at the time you got in, what you were feeling when you decided to pare down the position, what you were feeling and thinking when you decided to get bigger, how you hedged, did you hedge, what kind of work were you doing, what else could you have done. So you can build an elaborate template of things to review to make sure you're doing all the things that you could have done and to really begin to see what patterns exist in your performance. So you can look at how people, whether they earn money in the 1-day bucket, whether they earn money in the 2 to 6 day bucket, do they earn money in the 7 to 21 days, do they earn money 21 days to 60 days, are they making money on the long side, the short side? There tends to be a pattern, and each portfolio manager, and I work with many, has his own signature. The more you understand that, the more you're in a position to tweak it and try to decide what more you need to do in order to maximize your performance. It may be you hold the positions and you hold them, it reaches your price target, and you still hold them, and then they reverse and you get back everything you gained. I've seen that in the last several weeks. A number of people who gave back their whole year in the last couple of weeks. The market's been treacherous. You begin to ask the person the question, why didn't you get out? Well, I thought maybe it was going to go a little further. A year from now, you ask that same person the same question, he's very likely to give you the same answer. That's built into his DNA, and he needs to be able to recognize that so he can begin to slowly change some of his approaches to take into consideration the market and the stocks, and not just be managed by his own unconscious way of patterning the portfolio. I think the reason you want to be able to identify that is because you don't have control over the market, and you don't necessarily have control over how the market and the sentiment in the market is going to respond to moves in the stock or announcements about the stock. And the market we're in right today, sentiment and macro factors seem to be driving the moves independent or irrespective of the fundamentals. The traditional fundamental analysis doesn't seem to really be helping. So in this kind of a market, it's important for the individual to understand his own emotional response pattern, because that's going to influence what he does, whether he's going to double down, trying to salvage his loss, whether he's going to hold on, or whether he's going to pare down and cut his risk and reduce his drawdown, whether he's going to get bigger in his high conviction ideas. In a market where somebody's getting panicky, they tend not to do what the most sensible thing is. They don't maximize their best ideas. They tend to play defensively, and that oftentimes leads people to hold on to losing positions and build up a big drawdown. The more you understand how you're responding, the more of a handle you have on the way in which you respond, the easier it is to kind of change it. Not that it's so easy, but at least you're identifying if you have control over your emotional responses and you don't get panicked and you recognize when you're anxious but you stay objective, you have a much better chance of succeeding in the stock market than if you're being governed by your emotions. If some of your listeners go to my website, there are a few podcasts that talk about this at rekiev.com. I think the critical thing is when somebody has been successful, they have the memory of a successful pattern. When they start losing, they tend to get defensive. They start chasing after P&L and oftentimes get off their game. The critical thing is to reduce the size of the portfolio to a manageable size, reduce the size of some of their positions, stay concentrated in their high conviction ideas, stop chasing after every rumor, pare down their portfolio, get out of low conviction ideas, begin to run the book in a very risk-managed way, and then slowly but surely, incrementally, begin to build up positive P&L. And then as they gradually build it up, the important thing is to really get into the process and to build confidence in your process, or to go back to the process that worked, as opposed to flailing about and trying desperately to get it back in a few quick moves. So the critical thing is getting control over the process, getting control over your emotions, and then starting to do what has worked in the past.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
How do you handle weaknesses and strengths? If you look at my new book on hedge fund leadership, where I talk about working with others and trying to empower people, I put a lot of emphasis on focusing on strengths. And I think the individual has really got to do that himself to the extent he's working with himself or he's trying to improve his game. It's hard enough to do well if you're focusing on your strengths. I think focusing on your weaknesses is probably going to be too strenuous and exhausting, take you out of the game. I think it's enough to identify what you're good at and then maybe join up with other people whose strengths may complement yours so that you maximize the results you can get. Focusing on what you're good at is really, there's so many ways of succeeding in the stock market that it makes sense for the individual to concentrate on what he's good at, to concentrate on the sectors he knows, to concentrate on the kinds of bets that he's comfortable making. If he's taking, say, 5% positions in his high conviction ideas, maybe he needs to concentrate on getting to 7% positions in high conviction ideas, or maybe even a 10% position. Maybe he needs to do more work in those companies that he really knows well, as opposed to trying to be a Renaissance man. My experience has been that people who concentrate on one or two sectors tend to be much more knowledgeable about their industry and about the stocks in it and the competitive landscape and so forth, and can really leverage their knowledge when they get into other stocks in the same area, as opposed to being a generalist where it's just too diversified. I certainly know people whose family life has not been particularly satisfactory, who've been successful, plus if it is, but it's not the sine qua non of success. I think it would be nice to think that it is, but it may not be. I think the question you're asking is how do you deal with distractions? And the markets are very intense, very demanding, and it's the kind of career that in some ways requires 24/7. The most successful people are people who are very committed to being as engaged in the market as they can be, and they're willing to tune out distractions while they're concentrating on the market. For some people, that means at 4 o'clock the day is over and they go home. Other people go home and go out to dinner with brokers or colleagues from other funds, or they do research at home. I think there are going to be many different approaches to it. Each person's got to find that rhythm that works best for them, recognizing that it's probably not a 9-to-5 job. If you really want to be running hundreds of millions of dollars and you really want to have a successful portfolio or a successful fund, it's a very demanding kind of career. You really have to be able to tune out the distractions. It's not as Pollyannish as I'm trying to suggest. A lot of the conversations I have with people tend to be brutally honest. The task of a trading coach or a guide is to confront people, to wake them up, to throw cold water in their face, to really get them to see how much they have decided to produce the results that they are producing, that the results aren't by chance, but they are because the individual has made a decision, conscious or unconscious, to produce certain results. I've talked to a few people today who were not doing very well this year and challenged them in terms of, are they willing to dig in and really change some of their underlying approaches, which haven't been working, in order to increase the likelihood that they'll be successful. I talked to one guy who's like a deep value guy, and deep value, holding it and buying more as it goes down and buying still more as it goes further down, doesn't seem to be working in this market. And to hold on to that philosophy when it's really not proving to be successful, which a number of people have done, may not really make sense. But you have to challenge the individual to say you're making a decision to hold on to this approach which worked a few years ago but isn't working now. And are you willing to change that? And are you motivated to really try to succeed? To succeed, you may have to rethink your philosophy. That's not an easy conversation, because you're really, getting in somebody's face and saying they're responsible for how they're performing. It's not the market. That's a tough conversation. Not everybody is willing to have it. Maybe that's one of the things we talked about earlier. The people that are willing to have that have a better chance of changing.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
There was an article in the Wall Street Journal about a week ago. Actually, it was a Reuters interview. They interviewed me and a few other people, and everyone basically agreed that in this past year, with the increased volatility, there have been a lot of drawdowns and redemptions and folding of a number of funds, and people have not made as much money as they have in the past, and have, in fact, many instances lost money. So there's been a fair amount of stress. So people are seeing more patients from the hedge fund community going to psychiatrists, therapy, and for medication and so on. A lot of people seem to be going for yoga and meditation and, all the things that are out there designed to help people reduce stress. I've been working with traders for about 15 years and have always observed a lot of stress among traders. The trading game is a highly stressful game. It's a performance-driven game, just like professional basketball or football is, and so forth, in the sense of very specific targets, very measured performance, metrics as to how well you're doing, and how well you're doing when you're doing well, and how badly you're doing when you're doing badly, and all the different ways in which performance can be measured. Are you making money long term? Are you making money in the short term buckets? Are you making money on the long side, the short side? Are you hedged? There are any number of ways in which a portfolio is managed, and so you're continually observing people, assessing them, helping them develop skill at managing their activities so that they get the stress under some control, because the stress, to some extent, the emotionality and the anxiety associated with stress when they're losing or when they're confused or when they're too uncertain leads to poor decision making. A lot of the coaching I do has been to teach people principles of focusing on the critical issues and not being distracted by noise, to be aggressive, but aggressive in a controlled way. As much as they may be alpha males looking to create alpha in terms of performance, they've got to do it in a controlled way and not in a explosive, impulsive, out of control, angry way, because that interferes with their judgment. They've got to set goals. They've got to then have a strategy or a process for reaching those goals. And to the extent the goals are stretch goals, that creates a little bit of stress, some of which is helpful in getting them to focus, in getting the adrenaline going, and getting them to do more work than they might ordinarily do. So to do that requires a certain amount of objective ego. It requires an ability to stand back and recognize when you're emotionally reactive and are interpreting events in a reactive way, and you're interpreting your own responses in a reactive way as well. It says, oh my God, something's going on, I'm losing control. You've got to learn to stand back and look at changes in prices and changes in movement as reflective of the characteristics of the market, of the stock, of the sector that you're in, and be able to make decisions based on your analysis rather than on your emotion or the sentiment that's driving the market. In a market like now, where it's much more sentiment and macro-driven, the usual fundamental analysis doesn't work, which is making people even more frustrated. There are a lot of practical psychological principles that can be taught, and some people are more receptive to learning those and then employing them as they handle their portfolios. When a time gets to be a tough time like this, those guys who've learned some of these principles, they learn they've got a routine, they prepare, they write down their plans, they write down alternative plans, they write down what sort of a scenario analysis, what they're going to do if the numbers are one way, if the numbers are another way, if Bernanke says one thing or another. They have a plan, so they're able to kind of act fast when the event occurs. They've got catalysts and so forth. Any kind of recreational activity that gives you a chance to get a break and re-energizes you is obviously a beneficial thing. Taking a few days off every month is a good thing. If you can do an athletic routine during the course of the week, that's a good break. From the point of view of focusing on stress relief, I recommend that people practice meditation or yoga or some kind of relaxation practice. It could be deep muscle relaxation, it could be deep breathing, it could be Tai Chi, it could be a number of things. Doing that 30, 40 minutes a day, sometimes early in the morning, just to get into the centered state, and so that when you're experiencing stress in the course of the trading day, you can very rapidly put yourself back in that same centered, relaxed state where you can visualize the much more effective way of trading particular positions. It's very hard to learn that when you get into stress. You've got to really have practiced getting into it in a non-stressful situation so you can use it when you're in stress. A specific technique for doing that is useful than some of the things I've talked about, like self-coaching, self-talk with positive images, focusing on the task, choosing what you have, deciding that, well, this is what you've chosen to do, and you're going to have to learn how to manage it. I think those other things are probably useful as well.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Having a particular profit target and what's your expectation? How much profit you're going to make in a quarter or in a half a year or annualized, and then what work have you done to support that thesis? What's the variant perception, or what's the unique non-consensus way you have of seeing the company, of seeing some transformative events that are going to unlock value? To what extent do you have a path to getting paid, and to what extent are you sizing the position commensurate with your level of conviction? There are any number of variables that you would bring into play in terms of sizing your position and making your bet. Optimism doesn't really have too much to do with it. It has to do with the quality of the work, the quality of the differentiated view, the understanding of catalysts, and then getting sufficiently big that if it works, you're going to make X amount of dollars. So it's a probabilistic bet based on doing fairly thorough work. If you're just relying on your optimism, you're probably going to be in trouble. Being optimistic is fine, but my experience has been that people who are successful are really digging deep and really understanding the models and what are the factors in the earnings announcements and the product releases and the competitive landscape, which are going to give you that extra edge, enabling you to make your profit targets. I think the amateur probably is a little bit more governed by his emotion. The more experienced traders and investment managers are really focusing on the quality of the work. And that being said, in this kind of market where it's very volatile and where it's driven by sentiment and macro factors, the fundamentals don't seem to be working as well. So it's a lot more difficult to make money at this time. And I'm advising people to pare down, take a little less risk, keep some powder dry, and wait until there's a little bit more rationality in the market. I think what you see is individual investors oftentimes chase after stocks. They want to buy it, it goes up. They start buying it, it goes up further. They start chasing it, or they hold on to positions and they start to lose money in those positions. So they keep holding. The stock reverses and they lose all the profit that they've made. They're getting carried away by the emotionality of the market, and they really don't have a handle on what it is they're doing. Excessive trading is not per se a desirable thing. Trading is fine when you have a rationale, when you've got a catalyst, when you've got some events occurring that are going to influence the stock, when you know something that other people don't yet know. But just trading to trade tends to work in a counterproductive way. I recommend that people start keeping a diary of what they're feeling, what they're doing, what the reasons are for their decisions, and to develop a little more objectivity about what they're doing, and recognize that that this is an activity that requires a fair amount of thought and consideration and objectivity, and the more they're sort of aware of their own impulsivity and tendency to take too much risk, hoping to too much risk in order to make back their profit or make more profit, the more they can approach this in a much more calmer way, with better understanding of the reasons for why they're doing what they're doing. I mean, it's very easy to go in and buy something and sell something and so forth, and so the entry into the game is very easy, but most people don't make money because they really don't know what they're doing, or they're carried away by their emotionality. And the markets are triggering off emotions all the time, fear and greed, and you've really got to get a handle on that in order to be successful. I mean, one of the big lessons to learn over time is to be patient, to wait until there is an opportunity, and recognize that most of your profits are going to be in a very small percentage of all your trades. I mean, while you may be right 60% of the time, most of your money is made in about 3% of your trades. So you want to be able to recognize when that's happening so you can get bigger and stay a little bit longer in winning trades. Ideally, you want to have an entry strategy and an exit strategy when it's getting close to the number that you had settled on, unless something has changed and there's really justification for staying in longer. You're well advised to start paring down and getting out. What happens is people say, oh my God, it's really working, and instead of doing more work to justify continuing to stay in, they just stay in or get bigger, trying to ride it out. They're being carried away by their own elation and euphoria, and they're likely to get into trouble at that point. You've got to decide. The stock's at 10 and you think it's going to 20. When it starts getting to be 18, 19, unless something has changed, you want to start paring down and getting out, and not get carried away by your excitement about making money. It's not just automatically going to be a triple. This is all based on the numbers and based on on events and based on how the company's doing relative to other companies, what the earnings look like, what the guidance has been, what the market is doing, any number of variables. Let's say you say, I want to make 40% in this investment, which means 10% a quarter. If you've made 10% in a quarter in 3 months, maybe that's sufficient. Maybe you want to now take your money and put it into another stock that's going to go another 10% for another quarter. Or if it looks like it's going to continue and you've done the work, got the models, you've done the analytics, you've really looked closely at the kind of data that's available, you may want to stay in it. And on the other hand, you may want to get out of it and put your money in something else. You're always ideally being run or dominated or influenced by your profit target. That creates the framework for your strategy and how you would implement it. Not that you're obsessed with producing the result, but you're using that to frame how you size positions, the kind of work that you do, the kind of analytics that you find necessary to really understand why the stock is moving the way it's moving. The amateur doesn't necessarily have the resources to do the kind of research that's necessary. He doesn't have the time, he doesn't have the infrastructure, he doesn't have a team of analysts, he doesn't have other people around who are doing the same kind of work. But it takes a lot of time and a lot of effort. And if you've got a full-time job, which is not the market, you don't necessarily have the time to do the work, which is why you're probably limited in how many stocks you can really invest in. Even people who are really skilled professionals don't have an easy time of it. So I would say that somebody who doesn't have the kind of infrastructure or resources to help him, this game is a tough game. I mean, I went to medical school. I don't do appendectomies. So you kind of, over time, learn what your limitations are. And if you work with professional traders, you realize how much the ordinary person is handicapped. I think you probably have to decide what it is you really have some kind of competence in. What industry do you really understand? What companies do you know well? You probably have to have a defined universe of companies that you're working on, so that as you do the work, you can keep building the models, you can keep building your database of information, and develop some knowledge and expertise in a number of companies, probably a limited number of companies, and you can probably make a decent living trading in and out of companies that you really understand. I think that would be the way to do it, rather than to just be a generalist who's doing banks and biotech and tech and insurance and commodities. I think you've got to narrow it down to what kind of expertise you might have and the kind of thing that you're inclined to do, and work on that. And recognize that, if you have 5 good ideas in a year, that's probably a pretty good number. And if you really work on those, then the next year you could probably add another 1 or 2 more. But you're building strength and knowledge about the companies that you're trading, so that you're familiar with them. It gives you a little bit more of an edge. It can also guide your reading and guide the research process that you might engage in. So at least you know what you're doing. And then you could be spending time reading books like, some of the books on the psychology of trading that I've written, which, give you some awareness of how your own emotionality colors the way in which you invest and colors the way in which you respond to the market. So you have a little more objectivity and are able to make more rational decisions. And then patience. You don't have to do it all today. You can do it over time. And you can wait until you really see the opportunity. And then you can build a network. You can, join a chat room or build a network of friends who are interested in trading and, belong to some kind of stock club, so that you're exchanging information and getting a little bit more knowledgeable and informed about the kinds of things that you could do. There's no one way of making money. Everybody does it in their own unique way, and usually they are relying on what they're good at. And so the more you can identify that, do you like to read 10Ks and 10Qs, or Do you like to, interact with people on the phone? Do you like to network? Do you like to visit companies? What is it that you're given to do so that you can begin to build your knowledge base based on what your strengths are? So it makes it a little more interesting.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
I guess it's fair to say that I've been dealing with stress in the markets for a number of years, and so most of my books have talked about stress. I thought it was time to write one that was totally focused on the issues of stress, trying to define it and what some of its characteristics were and how people could deal with it, how it manifested itself in terms of changing behavior in the markets, how under stress people tend not to follow their strategy. They tend to play defensively. They tend to hold on to losers. They don't get bigger in their higher conviction ideas. And they're basically not as centered or as focused as they are when things are going well. So stress actually throws you off balance. So it manifests itself in a variety of trading behaviors, and to the extent that the individual gets a handle on that, they're better suited to going back to following their strategy and making money in a way that's proven effective in the past. I'd say this year and in the last several months, the market has been very much driven by sentiment and macro events, and the usual fundamental analysis, which tends to give people an edge, hasn't really been working. So even when the analysis suggests the company is a good long, the markets don't follow through. There aren't enough buyers, there aren't enough sellers, there's a lot of volatility, emotionality, and irrationality, and people are being taken out of their game quite consistently. And you're seeing this in terms of redemptions, in terms of hedge funds closing down, in terms of poor performance throughout the industry. I think the principles that apply to professionals apply to the ordinary investor, obviously dealing with smaller sums of money and perhaps less risk. But I think some of the principles are the same, that the individual who's investing his own money has got to be very cognizant of the natural inclination of most people to hold on to losing positions, hoping against hope that things are going to turn around, and taking more risk in losing situations than they're inclined to take in winning situations. Person's got to be aware of this and really make corrections for it in terms of getting out of situations where he's losing money, or getting bigger when things are working and there still is reason to believe that there's still more upside in the opportunity. So the principles are the same. The psychological underpinning of buying and selling stocks is pretty universal for both the amateur and the professional. Professional may have a little more savviness and a little more support and infrastructure and a risk manager and various other people that may help them in managing their books to make sure that the volatility on the long and the short side are equivalent, or that the beta is matched on the long and the short side. So they're getting more support, they're taking bigger risks, they're held to a higher standard, but the principles are the same, and that is that people are inclined to hold on to losers because they don't want to admit they're wrong. They hope things are going to get better, and they allow their sentiment and their emotion to govern their decisions as opposed to objective factors. The same thing in terms of winning. You've got to be able to say, look, this is working. And to the extent that I know that the bulk of my profits in the course of a year are probably going to be in a very small number of my trades, when something's working, I've got to identify that and really have the moxie to get bigger and take more risk when the opportunity calls upon me to take it. Some people would argue that they're under more pressure when they're trading other people's money than when they're trading their own. It's probably very subjective and very individual. In both instances, the critical thing is when you start off the beginning of the year, you're flat and you've got just so much capital to risk. As you make money and you build up a cushion of profitability, you have a little more risk capital to put at risk for taking bigger bets. And this would hold for an individual as well as for somebody that was, a professional. So the critical thing is what's your profit and loss statement at a particular point in time. And if you've made some profit, you've got a little more leeway to take a little bit more risk. If you've not built up any profit, or you're in a job situation where you have what's called a down and out, the number at which you've lost so much that they shut your portfolio down. So your job's at risk. You can't take bets as big. You've got to be hitting singles and doubles and not going for home runs. And you've got to kind of build up slowly but surely, incrementally, some profitability in order to be able to, build a cushion and have more money to put at risk. I think the utilization of stress-reducing techniques, you can use standard techniques that are used, throughout psychiatry and psychology. The critical point I would make is that when you're in the middle of the stress of a stressful market and it's beginning to interfere with your concentration and your decision making and your sense of panic and so forth, it's very hard at that moment to start applying these principles. So I strongly recommend that people begin to practice some kind of visualization, relaxation, deep breathing exercise, yoga, meditation. It could be any one of a number of things, and do that on a regular basis so they're able to create so-called relaxation response. They're able to get centered, and they're able to kind of be in a relatively calm state where they can see things objectively and not overreact and overinterpret the meaning of events. When you're anxious and you're stressed, you tend to overreact to neutral stimuli and begin to think catastrophically, and then your reaction to the events and your reaction to your own bodily responses tends to escalate your anxiety and make matters worse. The more you can learn to stay cool, calm, and collected and get back into that state, the more effective you can be. So if you practice that on a regular basis until you can become centered, with a 1 minute visualization or exercise, then in the middle of the stressful day, you can kind of tune out, calm down, and begin to look at things in a more objective way. And I think that's the critical thing. It's very easy to buy a stock and sell a stock, and it looks a lot easier to do and to succeed at than it really is. It really takes a lot of work. The individual's got to really assess his own ability to be profitable in doing this, and not just simply do it for egotistical reasons or because he wants to be in control of his destiny. He's got to decide whether he really has an appetite for this and a willingness to do the kind of work that's required. At the same time, there's value in understanding the complexity of it and how it affects people who are trading, so that if indeed you invest with somebody and you have a chance to talk to them and see how they're managing your money, you've got a little bit more understanding of the kinds of issues they're going through, and you can vet their performance and their response and their attitude and see whether they've got a strategy, whether they're dealing with the volatility in the market and the uncertainty in the market, and whether they're paring down their portfolios and not taking too much risk because they don't really have a handle on what's going on. I mean, that becomes another way of managing your own money in that you have a little bit more understanding of who the people are that are managing your money if you've delegated it to somebody else. Are they managing it well? I just read 5 minutes ago about some fund that blew up and shut down, and the guy who was running this particular biotech book had been in 2 or 3 different funds before. And, you've got to assess the performance of the individual who's running your money, what his track record's been, how he's handling it. If he's giving you a lot of rationalizations, well, it's a tough market and we're dealing with binary events, and he's giving you a lot of theory and rationalization, he may very well not have a handle on it, and he may not be adequately handling the portfolio in a risk-managed way. He may not be running a balanced portfolio. He may not be hedging out the market risk by balancing longs against shorts and so forth. The more you know, the more you can make intelligent judgments about the people you're giving your money to manage. And we're really talking about a very time-intensive activity, and it may very well be that if you've got another kind of job or another kind of career, it's pretty hard to do the kind of work that people who are doing this for as a full-time job or kind of time they're putting in. In a hedge fund, where you've got a range of people handling different sums of money, you're able to compare how much money somebody is putting at risk now as compared to how much they were putting at risk in the past. How much money are they running? Let's say they're running $25 million, or they're running 50 or 100 million. The question is, if that's their buying power, how much of their capital are they using? I find there are some people who are very perfectionistic. They want 90% of the information about a company, and therefore they do a tremendous amount of work, and they oftentimes don't get into a position in time, and by the time they've done all the work, the stock has already moved and they miss the opportunity. Their extreme perfectionism keeps them from pulling the trigger and getting in sooner with, say, 70% of the information they need or 60% of the information they need. So they may not be using all of their capital. That's not an uncommon conversation about what do you need to do to be able to take more risk, and you may need to be willing to take your bets with less certainty about the certainty of the outcome of the idea. Other people are a little more impulsive and are quick to get in and maybe take too much risk. So they've got to notice that and maybe pull back a little bit and be a little more constrained. Each person's got a different combination of things. They may be too thorough and too cautious. They may be too urgent. They may be very bright, but don't have much tolerance or patience waiting to do the work. You want to understand what the personality profile is and how that may color the way in which an individual functions. The usual parameter is to suggest that an individual probably has a 10% position. 10% of his buying power could be in his highest conviction idea. So if he's running $100 million, he could have a $10 million position in his highest conviction idea. You would want to see him have a few 10% positions, a few 7% positions, maybe a few 5% positions, and so forth. In a difficult market such as we're in now, you might suggest that he pare down the number of low conviction ideas, which he has as placeholders, where he's waiting for more information, but he may be losing money in those. That's kind of a general guideline. It's going to vary from firm to firm, but that's kind of one way of looking at somebody. Do you have enough confidence in your ideas to be able to put on a 10% position? Do you have some sense of the catalysts that are going to unlock the value and a path to getting paid? Do you have some kind of profit target and a way of getting to that profit target? Are you sizing your positions commensurate with that kind of analysis? That's kind of the way you would start to decide as to whether the individual is taking enough risk. If a guy has just a lot of 2% positions, 62% positions, he may make a lot of money, but he doesn't have any high conviction ideas. He's playing a different sort of game. That's fine too. Each individual's got to find that style of trading that's consistent with the way he's most comfortable doing it. There is no one way of doing it. It's very, very individual. It's very much a signature activity. Now, sometimes people have tremendous statistics, and it's fair to say they could take more risk and even allow their statistics not to be so good. They don't have to have such a high Sharpe ratio. Sometimes they have a Sharpe ratio of 3.2. Maybe they don't need one. That's a risk-adjusted rate of return. Maybe they don't need that much, and maybe they can take a little more risk. But again, they may be very cautious and very thorough and very precise, and that's a style that's reflective of their personality.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
It takes a fair amount of experience to recognize that the market is bigger than you are, and that it makes good sense to pay attention to the market when things aren't working, to reconsider your point of view and perhaps pare down and manage the risk better, and preserve your capital so you can come back another day and continue to play. Most of us are hardwired to take bigger risks when we're losing and hold on to losing positions than to take bigger risks when we're winning and get bigger. Daniel Kahneman won a Nobel Prize for his so-called prospect theory, which deals with this principle. And the master traders, and I've written about this in a few places, are people who've learned to function independently of the way in which they're hardwired. As much as the inclination is to want to hold on, hoping something's going to turn around, the wiser decision is the risk management decision to cut your losses and come back in when the thing is starting to move in the direction you wanted it to move, so that you don't become too attached to something just because you understand it and believe it. You have to, adapt to the circumstances. I think the best performers tend to be people who are relatively humble. They may be masters in the universe in a sense, but they recognize they don't know everything. They recognize that there's a lot to be gained from working with other people, from having other people hold them to their commitments, from having other people provide strengths that they may personally be lacking. Recognize that nobody has all the cards, and it's necessary to work with other people. So as much as this is an individualistic sport, the people who have learned to be team players find that there oftentimes is a synergy and something greater when more than one person is involved. The essence of that is good communication. So people have to, from the get-go, begin to recognize that it's important to be able to speak with candor and to make sure that you're telling the truth, that people are telling you the truth, that you're working through snags and difficulties and different perspectives so as to gain the benefit of being part of a larger group. If you're a PM managing a substantial amount of money, you want to have a team of analysts who are helping you dig deeper into company products and company growth cycles and earnings reports and stuff like that. And you can't do it all by yourself.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Well, the most recent book was called Hedge Fund Leadership, in which I talked about leadership issues in hedge funds. Many people who develop hedge funds start off as traders, or they start off as analysts and they become traders and portfolio managers and so on, and they rarely have developed the necessary skills for managing other people, and so they begin to add people, but they don't necessarily know how to get the best out of them. They don't necessarily know how to motivate them or empower them and so forth. And some people are better at it than others, but it's definitely a set of things that can be learned. I mean, where people learn how to listen, where people learn how to identify the strengths of the personalities of the people that they're dealing with and try to encourage them and help them to work around what they're good at. Some people are very thorough and very cautious, and they tend to make very good analysts. Some people are more prone to want to take risk, to act urgently, to sometimes maybe even be a little impulsive. They may make good portfolio managers because they're willing to take risk, they're willing to deal with uncertainty, they like the action, and they may be able to raise a lot of money, but they may not be able to manage other people. I talked to somebody the other day, and I said the critical thing for him was to hire somebody who would handle the management of the people in the firm, because that was not what he was skilled at. It's not that he can't learn it, it's that if he's interested in learning it, by all means do so, but not simply do it in a kind of crude way. I spent a lot of time dealing with communication and getting people to talk about what they really want, to express themselves, and also to listen to other people. And as simple as it sounds, it takes a certain amount of practice, a certain amount of willingness to discuss the larger issues about communication and collaboration and so forth. So as much as people are competing, they also want to be working for the common good, and it takes a certain level of maturity and a certain level of understanding to do this. Well, maturity, to some extent is having a sense of humor about yourself, not taking yourself too seriously, not having to have everything your way, recognizing that other people have a lot to offer, that maybe there is a lot you can learn from others, that you are well advised to pay a little more attention to the way people feel and to how you feel and so forth. So it really gets at what's been called emotional intelligence. And I think the most successful traders are the ones who've evolved to a point where they appreciate these larger issues and spend a certain amount of time dealing with that and encouraging the people on their team or in their organization to explore those kinds of avenues in order to improve their ability to function and to endure through difficult times. I mean, and recognizing that there's a lot of value in understanding your emotions and learning to ride them out and learning to use them as clues as to what's going on, and to try to kind of find the right balance to keep in order to be able to function as effectively as possible. It gets back to what I was talking about before, which is really why it's really advisable for people to get coaching and support from somebody who has some kind of objectivity. Most of us tend to be self-justifying and continually, if we're in a difficult situation, to kind of rationalize it and put a Pollyannish view on it rather than face the fact. If you've lost so much money, maybe it's time to pull out, reduce the size of your positions, reduce your investment, go to cash, reserve your capital, and wait until the situation's a little bit better and a little more positive before you get back in. But people don't want to admit that they were wrong. They don't want to admit that they're failing. They don't want to face that, and so they get into a state of denial and aren't able to adjust or adapt as well as they might.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Many of the people I'm talking to are beginning to get their confidence back. They're somewhat more optimistic about the markets. They're cautious. They're not fully invested, but there's some general consensus that we're finally getting out of the bear market, and while there may still be some down moves, there's a sense that the economy is stabilized. The job unemployment rates have started to decline. There's some more stability in the banks with more lending. I mean, we're still in precarious times, but the general feeling is that things have gotten better, and that and the markets are starting to reflect that. To the extent that the markets are 6 months ahead of where things are, they're kind of a forward indicator. It may very well be that things are getting better. So while people were hurt last year and still have high watermarks this year to pay back what they've lost, there's a little more optimism that I'm seeing. I had a conversation with a senior PM the other day, a fellow running several $1 billion, and asked him about what role emotion played in his trading. And he says he's got to factor it in. He's got to pay attention to it. He's looking to feel comfortable and have some sense of confidence about the trades he's making. So his psychological equilibrium is a critical variable in terms of how he approaches the market. He then has to, so there's a certain amount of instinct, experience, pattern recognition, which gives him some kind of a sense that things are right. He then does a lot of work, and he puts his greatest emphasis on the intellectual work, the fundamental analysis of the company, the profit and loss statements, new products, innovations, the nature of the industry, and so on. So he's motivated to get all that data to support his underlying positive feeling. Now, if he's just relying on his feelings, he's going to be in trouble. If he's overwhelmed by his feelings, he's going to be paralyzed. If he's overwhelmed by his data, he may be paralyzed. So there's a constant effort to balance emotion and intellect. He's an accountant, an engineer, and then he became a money manager. So he's a little bit strong on the mathematical and analytic side, but he recognizes fully the underlying the importance of emotional stability and not getting too carried away by your emotions, but nevertheless recognizing the significance of what your emotions are signaling to you. When you're starting to feel uncomfortable, things aren't going well, to some extent that may be a positive sign, but you've got to pay attention to it. The critical thing is, I spent a lot of time talking to people and trying to kind of translate that into practical principles that people can apply, whether they're just guys trading at home on their own or guys working in a firm. The same principles. You've got to learn to manage your losses, and we're all wired to kind of minimize our losses, to rationalize them, to keep hoping against hope that things are going to turn around. The best people that I talk to have really had a reawakening as a result of the poor performance that was so widespread last year. And so everybody is much more, or the thoughtful people are much more focused on how they get themselves into the right psychological mindset, what are the things, the steps they have to take so that they can reduce stress, they can maximize performance, they can see the ball a little bit more clearly, they can keep their aggressiveness under control. The first thing is, of course, setting goals, realistic goals, but ones which require a certain amount of stretch so that you're forcing yourself to do things that you may need to do in order to produce the kind of profit you want, but that you ordinarily might not have done in the past. So it's going to require more concentration, more work, more preparation, a greater willingness to get involved in a coaching situation, self-coaching or coaching with a professional coach who can help you to make adjustments to overcome your over-emotionality, to overcome any kind of negative self-doubt or expectations of failure, which so readily infect and affect the way in which people trade. So the best guys have started to prune out of their portfolios weak ideas, marginal ideas, or unprofitable ideas. They've gotten out of instruments that didn't really work, that they didn't really know, but they had gotten into in an expansive mood when they were thinking about expanding their firm or building up the additional firepower in their portfolio. So there's more of an effort to concentrate on the areas of greatest strength, whether in terms of your own inclinations, the kinds of key people you have, what your capabilities are, where you've made money in the past, where you can expand your footprint in similar kinds of situations that have proven successful for you in the past. And this is really important. It's also important to kind of reset expectations about other people, what kind of metrics you want to apply so that you can measure people's performance, you can measure their level of accountability and how much responsibility they're taking on. I wrote one book last year called Hedge Fund Leadership, which really gets into the kinds of discussions that portfolio manager needs to have with his analysts and with his support team so that everybody in the firm is on the same page. People who are grousing or complaining or continually thinking about their own interests or quickly talked to and decisions are made as to whether they really are contributing to the culture of collaboration, which is so critical in this kind of business. So I think it's a very important consideration as to what is the nature of the culture, what is the nature of the leadership, what's the level of integrity of the guy running the fund, is he clear with people about what he expects, does he set out targets and objectives for him, or does he kind of change his mind and act in a very discretionary fashion when things aren't going well? Do people feel they can trust him? Does he feel he can trust them? Is there sort of transparency within the firm? And some firms are built up that way and they've got a great culture and people stay there for years. And there are other firms where there's tremendous turnover because nobody's ever clear as to what the objectives are and nobody's very good at talking about things that aren't very pleasant. So it's really a question of taking on some of the lessons Jack Welch has always written about in his articles and in his books about the importance of candor, the importance of being clear with people as to what you expect of them, how they're performing, where they're falling down, what they need to do to improve, what their plan is to improve. Are they willing to align themselves with the objectives of the firm?
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com. Welcome to Ari KIEV's Trading to Win, the podcast focused on helping traders to maximize their potential.
Well, I think the critical thing in terms of setting goals is to review what your past performance has been, to see whether there are any regular patterns to it. Do you consistently produce a certain result? Are you up 10% a year? Are you up 15% a year? Except for last year, which was really pretty bad for most people. And do you have some kind of a consistent track record? And that gives you a baseline against which to start making preparations to set a target based on risk reward, based on what you think you're able to do. So generally, I encourage people to set goals that are somewhere in the vicinity of what they've consistently done in the past, so at least gives them a baseline. And then what constitutes a stretch goal? What would take, what's a little bit challenging, realistic but challenging, so that they are encouraged to do more work, do more studying, develop some additional techniques, understand technical trading, understand get a little more expertise in a particular sector, understand certain kinds of stocks and certain kinds of industries. What is their strength? What are they good at? What do they like to do? What do they do naturally? And build a strategy consistent with their personal strengths, with the kind of support structures they have in their firm or at their home, wherever it is. What do you have that you can use to help you develop the plan? And what is your strategy? How many positions are you going to have? How much are you going to hedge those positions to reduce the risk of market activity and volatility, so that to some extent you're protecting your investment if the market goes in the opposite direction. And that may require that you take a course or you begin to do something to make sure you really understand the complexity of trading. I talked to a guy the other day who was following my advice, and he's built a formula which he wants his traders to follow so that he gets out of losing positions and he starts adding to winning positions in order to produce a 20-25% result at the end of the year. I said, that's fine, but you really want to be able to face some of the discomfort and know what you're doing, rather than kind of set it up simply as a black box formula. The more you can kind of embrace the uncertainty and the anxiety, the more you can recognize it when it's happening and how that leads you to make impulsive decisions or leads you to avoid making decisions, the stronger you get as a personality. And the stronger you are, the more you can face the music. You can cut your losses. You can add to your winners. Most people tend to hold losers and tend to get out of winners before they've actually reached their maximum point of their maximum target. So when things are really working well, you have to be able to recognize that they are and be able to kind of press the pedal to the metal. This takes self-examination. It takes keeping charts. It takes keeping a diary so that you begin to see when you got out, how you were feeling at the time, and how much your feelings, your anxiety, your uncertainty, your fear of giving up your profits led you to get out of a winning position and then leaving X amount or so much on the table. You've got to begin to be very objective in observing how you're handling yourself in the face of market movement and momentum and so forth. You've got to learn to have positive images. You've got to be able to talk to yourself to keep yourself focused and concentrated on the task at hand, rather than relying or reacting to the way you are emotionally feeling and then doing what you've always done in the past. How much are you run by superstitions and by your interpretation of anxiety and of, oh my God, things are happening in the market, I'm not going to make as much profit as I wanted to, or, I'm losing, but I still believe in it, I'm going to buy more as it goes down. Emotions are probably very useful signals, and it probably pays to understand what you're feeling, not allow it to impair your choices. At the same time, you want to get to the point where it's kind of like when you're skiing and you're in the zone, you're feeling the excitement, but you've got it under control. Or when you're sailing and you're sailing on the edge and you've picked up maximum speed, the wind is in the sails and you're really maneuvering it, that's really where you want to be, not where there's no emotion or no wind or no sliding down the mountain. You want that uncertainty, you want that kind of excitement, and you want to learn how to manage it. Being in the zone means you're more intense, you're more focused, you're more prepared, and you can relax because you've been there before and you know all the moves. So the more you prepare mentally, the more you can kind of relax and go with the emotion when you're in the middle of the action. I think it's a critical thing to begin to develop your own methodology based on the work you've done, based on your assessment of good ideas that you get from other people, but you put it through the sieve of your own template, you ask your own questions, and you begin to rely more and more on positive experiences you've had, which give you some gut or pattern recognition as to what's really working, what really sounds right, and so forth. So you begin to rely on your own emotional experience, which is sort of at a very deeper level likely to be able to integrate intellectual formulations, analytic processes, and so on, but it's got to be synthesized and then integrated into your own internal understanding of the whole process. You need to balance all the information against some sense that you have based on your life experience as to what really sounds right and sounds wrong, and you've got to learn to trust your instinct when you kind of say, this isn't quite right. And as much as this guy is very smart and he works for one of the big brokerage firms and he's got all the charts and so on, it just doesn't jive with my way of seeing things. I can't tell you how many people I talk to who say, I really lost a lot of money in a particular trade because I was trading something based on what a good friend of mine told me to do. These are smart guys who know their companies, they trust their friends, they don't have a feel for the stock that they're buying based on what somebody else has said. They haven't done their own work. We're all on some level insecure, and so instead of relying on what's worked for us, we somehow don't trust that, but we trust the strong presentation of somebody else based on how we perceive them. And it may very well be that we're relying, they call this the confirmation bias, where somebody tells you something that confirms something you already knew. And so you tend to kind of believe that, even though it doesn't really pass the smell test. You believe it because it's sort of confirming something you already know, and so you're not as questioning, and you're not as challenging, and invariably you lose more money in these kinds of trades than you ever anticipated. I talked to this guy the other day who's running about $6 billion, and I said, what was the one thing that you would say is the critical thing to account for your success? He says, everything I've ever learned, I've learned from mistakes I've made. So I'm continually keeping track of my mistakes and making sure that I don't repeat them. So I'm continually developing processes which try to anticipate the possibility of making the same mistake again. Ultimately, the one thing you have some control over is yourself. That's the thing you really want to learn as much about as possible.
Dr. Ari KIEV is an internationally respected authority on the psychology of trading. You can subscribe to his bi-monthly podcast full of real-world advice on how to maximize your trading potential at www.arikiev.com.